Hello and welcome to another Charts from Oliver Velez session. I'd like to once again draw your attention to the US dollar index. We're looking at a daily chart of the dollar index, and we're looking at that chart over a span of several months or so. What you'll find on this chart is one of the key moving averages that I place a great deal of importance in, a 50-period simple moving average. Now, for those of you who have been following my work for some time, you know that I'm a big believer in using key moving averages, and the 50-period moving average is one of those key intermediate term moving averages. I believe that the 50 should be looked at quite frequently when you're dealing with things over a several month period, 6 months and beyond, or 4 to 6 months and beyond. I like the 50-period moving average predominantly because it is a key moving average focused on by large institutions. Now, let's take a look at what's happened or transpired in the US dollar index over the past several months. If you look to the left-hand side of the chart here, you'll find that the dollar index was in a very severe move to the downside. Every single move, every single drop away from the declining 50-period moving average did produce a monthly new low. Each time the dollar index attempted to rally, it found significant resistance at or near that declining period moving average. Now, I've marked two key retests of the declining 50-period moving average, which occurred in November by circles. Okay? Now, I'd like to point your attention to the periods of time, the period of time when the dollar index moved significantly away from the 50-period moving average, meaning the drop separated itself from the 50-period moving average. We find one such large separation in October. Now, I've marked the separation by an arrow showing you that there's a lot of air or space that materialized between the current price of the dollar index and its key moving average, the 50-period simple moving average. Now, whenever any financial instrument moves significantly far away from a key moving average, creating a void or a lot of space, you know that you're closer to a snap back toward the mean. You're closer to a rally in this case that will bring the financial instrument, in this case the US dollar index, back toward the 50. Now, that rally back toward doesn't necessarily have to touch it, but the space is typically going to be narrowed. Let me show you another period prior to that October period where there was a fair degree of separation that materialized here as well. Now, we find another separation, all right, that occurred in the latter part of November. Now, remember, we're measuring from the key moving average to the absolute low of the move. Now, I'm going to point something out very interesting that might even appear as a little bizarre to some of you who are not familiar with what I call measured moves. Take a look at the size of this first arrow, and let's compare it to the size of this arrow. Pretty close. Now, let's take that arrow and compare it to the size of this arrow. All right, now, a little bit larger, of course, but I think you follow what I'm saying. There is a tendency for your spaces, look at how perfect that one is, the spaces between your extreme moves to be close to identical. Look how perfect that one is. So let's go over this once more. This arrow is the same as this arrow, is the same almost as this arrow, and we're a tiny bit off here, but nothing's going to be perfect. This is what I call the measured move. Now, when you find a financial instrument that is so perfectly in sync with its measured moves, whether those measured moves are beneath the key moving average or above the key moving average, it can serve as a wonderful means to determine with pinpoint accuracy when a move is near its extremity and when it's due for some type of pullback. So based on the measured move concept here, we are relatively close. Sorry about that. We're relatively close to a pullback materializing in the dollar. Now, it doesn't mean that you're going to get perfection here. It doesn't mean that, for instance, right now, since we, and this chart, which is this is actually about a week old, it doesn't mean that the dollar index should fall immediately here. What it does mean is that you're closer to a drop in the dollar than you are to another very strong extended move. Now, is another strong extended move impossible to occur from this elevated measured move? No, it's not totally impossible, but is it likely? It's not. And that's what proper market analysis and market trading is all about. It's about identifying probabilities and going with those probabilities. Now, a lot of you are very familiar with my ATM approach when I'm micro trading and my scaling in approach when I'm core trading and playing playing my various wealth strategies. A lot of individuals ask me, well, Oliver, with these scale in opportunities, do you ever go against the trend? And I'm always reluctant to answer that question because the answer depends on not necessarily what I do. The answer depends on what I believe is the right answer for the person who's asking the question. If a relative novice is asking me the question, my answer is going to be, well, not really. If it's a slightly more advanced market player, I'll say sometimes. If it's a phenomenally advanced market player, I'll say, of course, I go against the trend when it's intelligent to do so. Now, I'm almost scared to do this, but there is an appropriate way to go against the trend. And going against the trend is going against your key moving average. So we find that on the right-hand side of the dollar's chart here, what's happening? The 50-period moving average is rising, which tells us that our odds are better on the long side. We should wait for a drop back toward the 50, look for a turning opportunity in the form of a nice elephant-sized bar at or near the 50, and then jump on board the dollar. However, you can actually intelligently play the move back down toward the 50, then reverse, go long, and play the move back away from the 50-period moving average. Now, that's a very advanced technique and does require some additional skills, but the way you do it is once your financial instrument, in this case the US dollar, gets to the measured move location, that's when you start scaling. Does that make sense? I hope so. So we would start scaling now. And what does that mean by scaling? Well, I would start putting on my first short position. Let me do this. I want to show you. I start putting my first short position on up in this area. And then maybe a second one. As it went higher, I'd scale in. I'd never put my whole lot. That's what a novice does. Oh, I'm going to go short here. This is the single needle in a haystack price. Of all the prices that are possible, this is the one I'm going to put all of my chips in. This price right here. Come on, give me a break. That's kindergarten ABC style of market play. You don't ever put all of your chips in one price. You take your allotted planned amount that you're going to put into this play and you break it up into 10 or 20 pieces.